new proposed changes to the capital gains inclusion rates,
increasing from 0.5% taxable to essentially 2/3 taxable now.
every single dollar which is going to be exposed to capital gains tax,
which means even for this person who's not in a very high tax bracket, is going to be hit with a very hefty tax bill, quite detrimental, not just for high income earners, but for people who may be in the middle class as well.
Yeah. It is. I totally agree. I'll be bringing each week a different guest with all the answers that you have the questions for. And this way you can come back to my podcast for any questions that come to your mind, and you can focus just on working, as everything else this podcast will provide you. Hi, welcome to Simple Wealth Wisdom Podcast. I'm your host, Sim Gakhar. My work helping successful business owners and professionals like you build and maintain your lifestyle and legacy exposes me to very interesting specialists in tax side, accounting, law, estates, and investment side. In this podcast, I share those people with you and your team so you can hear directly from them. So if you are a successful business owner or self-employed professional, stay tuned for a lot of business building value ideas. Today, I'm very excited to have a wonderful guest, Jeannie from Manulife, as my guest. Welcome, Jeannie.
Thank you so much.
In today's podcast, I'll be asking the questions you have asked me so that you can hear directly from her. So let's get to it. Welcome once again, Jeannie.
Thank you.
Jeannie is the Assistant Vice President of Tax, Retirement, and Estate Planning for the Central East region of Canada. As a member of the Manulife team, Jeannie works closely with insurance advisors like me to support their high net worth clients like you to deliver integrated insurance, estate, and tax planning solutions. Jeannie received the Bachelor of Business Administration and a Master of Management and Professional Accounting from the University of Toronto. She's a member of the CPA Canada, CPA Ontario, the Canadian Tax Foundation, and the Society of Trust and Estate Planning Practitioners, TEP designation. Wonderful. I love that. Now, I would like to ask some questions from you, Jeannie, that a lot of viewers who are professionals and business owners have in their minds. Myself as a business owner, myself as a professional, there's so many questions in my head which are unanswered. And I put myself in the shoes of the same people. And now I'm going to be asking the questions which people have asked me, or I have the questions which are running in my head. Sure. And thank you so much for taking your time out of your very busy lifestyle and come in here and help my viewers.
No problem. My pleasure.
So right now, the hot topic is new budget, the new tax rules.
Yes.
That's everywhere. Everybody's talking. It just happened like a couple of weeks ago. So I would like you to share some knowledge about how do the new proposed changes to the capital gains inclusion rates impact small business owners and self-employed professionals, because most of the clients are investors as well. People do have investments. How does capital gains new rules impact?
First of all, I like to give a little bit about the background changes for the budget changes. So the budget actually introduced was around 2 weeks ago, basically says that the capital gain inclusion rate is increasing from 0.5% taxable to essentially 2/3 taxable now. So it's a very large increase. And so for individuals like you and me, natural people, they've essentially bifurcated the capital gains into two buckets, effective as of January 25th, 2024. Mm-hmm. So after January 25th, 2024, the capital gains, the first $250,000 of capital gains is still going to be subject to the 1/2 inclusion rate, the 50% taxable.
Personal. We're talking about personal.
We're talking about personal.
Personal, yeah.
Exactly. But anything in excess of $250,000 is now going to be subject to the 2/3 inclusion rate, which is 67% taxable. So for example, if you have $100 of capital gain now, your taxable portion is $50. Assuming you're in the highest marginal tax bracket, you're going to be paying around $26 of tax on the $100 of capital gain. Under the new proposed rules, assuming you're at the 2/3 inclusion rate, $67 is now going to be subject to the taxable amount adding on your marginal tax bracket of around 50%, which means you're now paying $33, $34 in taxes. So it's an increase of approximately 9% of additional taxes for individuals such as you and I. On the other hand, if you have a corporation or a trust, they're not giving you any sort of threshold limit. They're just saying for every single dollar of capital gains you earn in the corporation or trust is now going to be subject to this increased inclusion rate of 2/3%. So it's actually very detrimental for corporations and trusts.
That's right. So most of my viewers who are business owners, every single dollar which is going to be exposed to capital gains tax is going to be, there's no forgiving of 250,000 at the back.
Exactly.
Rule. So everything is going to be,
it's pretty hefty. And, the government in their budget are saying this is only for high income earners. But what if you had a situation like you had somebody who's retired and they're living off of a small pension income, but they have a cottage property as well as their principal residence? Let's just say they purchased a cottage like 40 years ago when real estate prices were much lower.
Yeah.
The amount of capital gain inherent in that cottage is quite large, which means even for this person who's not in a very high tax bracket is going to be hit with a very hefty tax bill when they potentially pass away or when they actually sell the cottage in the future. So it's actually a very, very bad tax change. And not only that, but for a lot of business owners who are incorporated, for example, doctors, a lot of doctors, they, instead of taking money out of their medical professional corporation, they keep it there for reinvestment purposes, because if they take the money out, they're going to be hit with the second level personal tax hit as a dividend, taxable dividend. But they keep it there for reinvestment purposes because unlike employees, they don't get a pension. Doctors have to save money for their retirement in their corporations.
Right.
So instead of hitting them, they're basically hitting them on a very high tax bill, because now for all of the investments in the corporations are now going to be subject to these 2/3 capital gain inclusion rates. So it's actually quite detrimental, not just for high income earners, but for people who may be in the middle class as well.
And it wasn't even done something like, if they said that somebody who buys today, this applies from today.
Exactly.
It's done from anybody who's had it whenever. So that's something really, I know.
It's quite upsetting because, like you said, it's not like, hey, capital gains, as of this date is going to be subject to this high. It's what if you held the property for the past 50 years? All of the unrealized gains up until this date is now going to be subject to this higher inclusion rate, which is, in my mind, a little bit unfair.
Yeah. It is. I totally agree. And very especially, I'm in the same boat. I'm a business owner. I'm a professional. I have investment properties in my corporation. And I know that this is all going to be, so it's a big hit actually.
Yes.
But I work with professionals and business owners, and I help them save those taxes using insurance strategies.
Yes.
So now my next question to a tax expert is that how can life insurance help reduce the impact of these changes to the capital gain inclusion rates? We are of great help at this point of time.
For sure.
How can we do that?
So life insurance is actually a very good alternative investment option. When I say alternative investment option, why is that? Because life insurance policies, you can use it as, if you're leaving the money for your estate or to your beneficiaries, for example, you're not using the money right away, you can use the life insurance policy as an alternative investment option, because a life insurance policy is considered to be an exempt asset, which means none of the increase in the cash surrender value over time is subject to tax, which means you're not even taxing the increase in the cash surrender value at the capital gains tax rate. And when the death benefit ultimately gets paid out to your estate or to your beneficiaries, it gets received tax-free, which is great if you have a personal policy. On the other hand, if you have a corporate policy, the good thing about having a corporate policy is that the fair market value of usually when you have a corporation and you pass away, the deemed disposition of the corporation's shares is taxed. The unrealized gain on those shares is taxed in the hands of the individual when they pass away, subject to the 2/3 inclusion rate, potentially. But the underlying share value, the fair market value, depends on the underlying assets held by the corporation. Generally, it's the fair market value of the assets minus the liabilities. However, for a life insurance policy...
I'm going to stop you, interrupt. I'm sorry about that.
That's okay.
I know some of my viewers might not have understood this.
Sure.
Can you please explain this particular part once again?
Sure.
With an example of $100?
Sure. For example, if you have a corporation and the only asset held by your corporation was, let's just say, a life insurance policy. Let's just say the death benefit is $100.
Right.
Okay. But the cash surrender value of the life insurance policy is $50.
Right.
Because usually the cash surrender value is much less than the death benefit.
Right.
Person passes away. The fair market value of the shares, instead of being $100, which is the death benefit amount, it's going to be the fair market value of the cash surrender value, which is only $50, which means the capital gain that's taxed is only on the $50, right? $0 to $50 versus $100.
Mm-hmm.
So the cash surrender value is actually a very good thing because the capital gain on death is a lot less.
Is there going to be a capital gain tax in insurance cash value? I didn't think so.
It's only because it's the cash surrender value sitting inside the corporation. So if you have a corporation, for example, if you incorporated the business long time ago, generally the adjusted cost base in the shares is very nominal. Let's just say
nominal,
zero, right?
Mm-hmm.
So you've invested it in your corporation, it's grown, and then you bought a life insurance policy for whatever price that you paid for the life insurance policy. So generally it's the cash surrender value because that's the hard cash amount essentially of the policy. Based on the Income Tax Act, they're saying that based on the fair market value of shares is dependent upon the cash surrender value, not the death benefit amount. So even though the death benefit may be $100, they're only going to be subjecting you to tax on the cash surrender value, which is $50, which is a lot less, which is a very positive thing.
So I'm going to ask you another example. I'm going to stick to the same point once again to make it a little more clear to everyone, because once it goes into my head, I'm going to assume it's gone into everyone. It's easier for everyone else also to understand. Let's say somebody had a policy and the death benefit was $100,000.
Sure.
And they were paying for the policy, let's assume $5,000 a year. And let's say that the cash value of the policy after at the time of the death was around $40,000. Okay. The death benefit, the person died, death benefit paid to the corporation because it was a corporately owned policy. $100,000 was paid to the corporation.
That's right.
Okay. So they were paying for $40,000 is the cash value. And now they never took out the money while they were alive. Money was in the policy.
Yep.
At the time of the death, 100,000 of the, death benefit is grown to, let's say, 140,000. Even that is grown because, death benefit also grows. What is the tax at that particular times on that? Are you saying that $40,000 will be subject to the tax as capital gains?
So $40,000, that's the cash surrender value, correct?
Yeah.
Right? So when you originally incorporated the company, assuming there's no other assets in the corporation, and you incorporated the business for, let's just say, $0.
$0.
Okay. So the cash surrender value, because it's a hard asset. Okay. They're going to say that the fair market value of your shares, because the underlying asset of the corporation is the cash surrender value, the capital gain is $40,000 minus the cost base of your shares of $0, which means your capital gain is $40,000. So under the old rules, $40,000, 50% inclusion rate, which means $20,000 would be your taxable capital gain. But under the new 2/3 inclusion rate, it would be a lot higher.
Yeah, maybe roughly around, I would say 28,000 or something like that.
Precisely.
Yeah. And this happens on the death. What happens if somebody dies earlier? Let's say 2 years into the policy.
2 years into the policy, the good thing is that
ACB
again,
is
it's still your adjusted cost base on your shares is still $0 because that's the purchase price that you had when you incorporated the business, and it would be the cash surrender value whenever you die,
which is going to be low in the beginning.
Which is low in the beginning. And the good thing about having a corporate policy is the death benefit minus the adjusted cost base in the policy is added to the CDA account.
Capital dividend account.
Capital dividend account, which means that money can be paid out tax-free to your estate and to your beneficiaries without any further taxes. So a lot of times a life insurance policy, especially a corporate-owned life insurance policy, is taking a tax deferral opportunity because you earn the money in your corporation at the, for example, active business rates, 12.2% in Ontario. And later on, when you're extracting the value out of the corporation in the form of CDA, you're not even taking the second level of personal tax hit, which another person who doesn't have CDA would need to pay, for example, 47% dividend tax rates in order to extract the money out. So it's actually a very effective tool for business owners to use a corporately owned life insurance policy to mitigate this increase in capital gain inclusion rate.
Absolutely. So I think this is something which every business owner now for the retained earnings should think, because capital gains is I know everybody's talking about that right now, but definitely there are some good things also happened.
Yes. Yes.
So what were some of the good changes that were proposed by the budget?
So the biggest thing is the increase to the lifetime capital gains exemption. So currently the lifetime capital gains exemption is slightly over $1 million, $1,016,000. But effective as of June 25th, 2024, any capital gains realized on qualifying small business corporation shares, the lifetime capital gains exemption has increased to $1.25 million.
Which is very right. Yeah.
Which is very good. Which
is only good if they're selling the business, right?
It's only good if they're selling the shares of the business.
Yeah.
So, I mean,
but still.
It's still good.
Yeah, if it's a family of 4, there's a big benefit of that, right?
Exactly.
So, as you said, personally, till 250,000, it is still the old rules, and after that, but on the corporate side, from the day one, it's the same. From the first dollar, it's the same. I want to ask you: do you think business owners still consider incorporating their business, or should they keep their business as a sole proprietor then?
It's a very good question. It's a very good question. So what I can say is that the tax benefits to incorporation still exist. The biggest tax benefit to incorporation is essentially tax deferral, right? If you were to earn $100 of active business income, 12.2% if you earn it in your corporation.
Yeah.
But if you earn it in your hands personally, you're taxed at 53%, which is significantly higher, which means that if you have a corporation that you're using for reinvestment purposes, you have $41, a little bit over $40+ of money that you can use for reinvestment purposes to grow your business, right? So this tax deferral opportunity is huge. And, the corporation still exists for X number of years, which means, this advantage is still there. It just means that you have to keep the money there for reinvestment into active business assets that don't trigger capital gains.
So I always say that it's a good problem to have. Having the money, there's always ways that you can work it out. And I know that capital gains tax, the new rules have really shaken a lot of people, but there are a lot of ways otherwise, using life insurance can be a very good thing. And again, small business rate for incorporating 12.2%, as long as you're making less than $500,000. If you make over $500,000, of course, 25%. But again, getting that. So it's a great idea still to do that. So what are some other planning points people can consider in light of the higher capital gain inclusion rates?
Yeah, so because the capital gain inclusion rate, the increase to it isn't happening until June 25th, 2024, the government is giving people a little bit of time to essentially crystallize their capital gain. So when I say crystallize their capital gain, it's essentially to lock in the capital gain at today's inclusion rate of 0.5%. So you can trigger your capital gain, you can sell it to somebody else, triggering your capital gain, locking in that 50% inclusion rate. But the only thing you have to keep in mind is the new AMT rules. So the AMT rules were introduced in the last budget, and AMT is essentially going to tax you more heavily on income items that have more preferential tax treatment, such as capital gains. So as long as the business owner has other types of high tax items, such as salary income, rent, interest income, then AMT generally shouldn't be an issue. So, definitely consider crystallizing some of your gains prior to June 25th, 2024, but keep in mind that AMT might hit you as well. So that's just another thing to keep in mind.
I know there's so many people who I know so many doctors, I know so many other people who have their investment real estate in the corporation, and now they want to sell it. The people are selling it at whatever because they really want to use that benefit of still the old rule. I would like you to talk a little bit about AMT, because I know that you've used this. A lot of people do not know that. If you can just explain it a little bit more, and how it can affect with your, corporation and tax rates. So if you can just talk about the same thing.
So AMT is essentially a parallel system calculating your taxes. So you have your regular taxes computed under the regular method, and then you have your taxes calculated under the AMT method. So AMT would essentially take your taxable income, adjusting it for certain other preferential tax items to come up with the amount of taxes you should pay. So you would pay the higher of the regular taxes or the amount calculated under AMT. So
what is the full form of AMT?
Alternative minimum tax.
Alternative minimum tax. Okay.
Yes, alternative minimum tax. So essentially, you're going to pay the higher of your regular taxes or the higher of your AMT taxes. Sorry.
Yeah, no, that's fine.
Yeah, and then essentially AMT tax is considered to be a prepayment of tax because if your AMT tax is higher than your regular income,
Mhm.
to the extent that it's higher, that amount you prepay in whatever year you had AMT, but then it can carry forward into future years. So in the future years, if your regular taxes is in excess of your AMT for that future year, your AMT that you prepaid can essentially reduce that amount of taxes.
Wonderful. Okay, great. And so, does it have anything to do with the capital gains tax then?
It does have something to do with capital gains tax because under the old AMT rules, essentially they were including, I believe it was 30% of the capital gain into AMT calculation, but now they're including 80% of the capital gain before was included in the AMT calculation, but now they're including the full 100% of the capital gain into your AMT calculation. So essentially you need to have other types of high tax income to avoid having AMT apply when you're triggering a large amount of capital gains.
That's great. That is, I think, a very, very good solution for everyone. Now, I want to go back a little bit more towards capital gains tax. Right now, what do you suggest business owners who want to invest their money right now? Do you think it is more suggestive to, if somebody has retained earnings, put it in GICs or put it in any other alternative investments, mutual funds, stocks, bonds, in comparison to putting that money in a life insurance policy and you're looking at it after 10, 15 years?
You know, I really think a life insurance policy in the investment option is the correct approach. Number one, because it generates CDA when the life insured passes away. Number two, it's going to reduce the amount of capital gain on death because you're only considering the cash surrender value of the policy. And number three, because a life insurance policy is an exempt asset, it's not subject to capital gains tax. Whereas if you have an alternative investment option such as marketable securities and whatnot, when you sell those marketable securities, you're going to generate a capital gain.
Yeah.
And within the corporation itself, it's going to be subject to the 2/3% inclusion rate. Whereas the corporately owned life insurance policy, you're basically going to avoid that because it's not subject to capital gains because it grows on an exempt basis.
Yeah, almost 50 to 60% of savings right there.
Yes.
So it's good to make a lot of money.
Yes.
It's always a good idea. But there's always ways where you can do proper planning with the right accountants, right advisors, and you can make it in such a way that you don't have to pay that big tax rate.
Exactly.
This is very good knowledge. I think, Jeannie, we need to have you back here because you have been so helpful. And right now, everybody has in their head so many tax questions. I know after this podcast is released, a lot of people are going to send me a lot of messages and they want to ask more questions about that. And we might need to call you back again because we love the way you share. So once again, thank you so much. This has been very informative and very helpful. As I always say in every podcast, not only for my viewers, a big thing I learned. That's why a lot of questions I ask for my own self. Thank you so much, Jeannie. I really appreciate you coming here and spending this time with my viewers. This has been very informative and helpful, not only for me, but for all my audience, all my business owners and self-employed professional clients. And that was another episode of the Simple Wealth Wisdom podcast. Please let us know in the comments what you like the most about this podcast. And if there's anything else you want to see or ask, I'll make sure to bring that to you in our future podcast. Watch for us again. Until next time, stay safe. I'm Sim Gakhar. Thank you.